Welcome everybody to TrueShares webinar. And today I'm very pleased to have one of my favorite PMs on the line with us, Mike Cerasoli of Eagle Global Advisors. Mike is the PM of the TrueShares Eagle Global Renewable Energy Infrastructure Income Fund, and also the co-lead of the energy infrastructure strategies at Eagle Global, which is a multi-billion-dollar advisor out of Houston. Michael's joining us from New York today. I'm in Chicago. I hope we have similar weather, which is scarily close to winter. But Mike will be doing most of the speaking today. That's the way you want it, and he'll walk us through obviously his viewpoint on the segment, as well as some of the recent activity around the space. We'll have time for a little bit of a Q&A at the end, but as usual, we'll try and keep this to well under 30 minutes. And for those that have registered, a replay will be made available to you as well. So with that, Mike, you are in charge here. I'll chime in when I feel appropriate, but looking forward to hearing your thoughts.
Great. Yeah, thank you, Mike, Loukas, and special thanks to TrueMark for hosting this webinar. It certainly is a pleasure to be here, and I'm going to start by introducing the audience to Eagle Global Advisors. Just a little bit more. Eagle is a Houston, like Mike said, a Houston-based asset manager. We have $3.2 billion of assets under management. I'm the co-lead of Eagle's energy infrastructure strategies, where we run just about $1 billion of Eagle's AUM. Now, a big chunk of this is invested in traditional oil and gas infrastructure, so think pipelines and storage. Though we've had a dedicated renewable energy infrastructure product since 2017, and we were ecstatic when we launched RNWZ with Mike and the TrueMark team in late 2022. And as we'll discuss today, we believe there are a lot of reasons to own Renews, RNWZ, I'll call it Renews. It's good for impact investors, growth investors, value investors, and of course the reason why we're here today, which is income investors. Before that though, I wanted to contextualize renewable energy infrastructure and why it's a good yield vehicle. Second. What's that? Switch. You get it to.
Is that working for you?
No, it's okay. It'll probably kick in. Oh, there we go. Perfect. That's the slide I need. So, all right. So this slide is an oversimplification of the renewable energy chain. So it starts at the left. That's the top of the chain with the builders. These are companies that harvest raw and rare materials, the manufacturers that use those materials, engineering and construction companies that actually build the assets. We lumped all these companies together on purpose because we believe they have similar risk profiles. They're not the same, but they're very similar, and that is they're risky. They have short-term contracts. If they have contracts, they can be highly sensitive to commodity prices. And they typically don't pay a dividend, and when they do pay a dividend, it can be highly variable. It's certainly not stable. In the middle of the slide are the operators. This is our focus. Here's where you're going to find the assets themselves. The companies that own and operate wind farms, solar fields, hydroelectric facilities, energy storage, etc. It's important to know we've included long distance electric transmission lines in here because energy transition is impossible without these types of assets. That is, being able to bring utility scale renewable power to the demand centers, which are typically in the cities. So these assets are supported by long-term contracts, typically with investment-grade counterparties, and in a lot of cases these days within the rate base of electric utility companies. So very stable cash flows, highly conducive to being the foundation of a stable dividend stream. To round out the slide, just to kind of finish it off, downstream, this is the right side of the slide, are the consumers. These can be residential, commercial, or industrial. Again, we're being overly simplistic here, but there are a lot of different companies here. But the one we wanted to identify is the local wires business. And so what I mean by that is this is the last mile of electric lines, the equipment you see on telephone poles and such. Local wires are owned by your local electric utility, highly regulated, comes with different investment characteristics than the operators. we don't consider local wires part of our universe, though the reason why I'm kind of going through this is because our portfolio will include, a lot of our companies will have this as a byproduct, these assets as a byproduct, because we're, again, like I said, we're kind of investing in utilities as well, and that's part of it. We're okay with this. If we're going to have to skew to one side of the chain, we'd rather skew to the consumer side, highly stable, and it actually further supports a stable dividend. So that's just to kind of put everything into context. All right, I think now we're both in control. Perfect, thank you. Okay, so you get it. We focus on the owners and operators. Who are these companies? They basically come in two classes: renewable independent power producers, so that's renewable IPPs, and the integrated utilities. Renewable IPPs are pure plays, as in they own mostly or entirely nothing but power generation assets. We focus on these companies that play a large or growing role in energy transition. So examples here would include Ørsted and Brookfield. Ørsted is primarily, it's a Danish company, primarily offshore wind. Brookfield, much more diversified, owns hydro, wind, and solar. That stock trades in the US. These fit very much into our universe. They're independent, and they usually come with a higher relative beta. So not nearly as high as those builders, but higher relative to a utility, higher risk than an integrated utility, or we'll call that UTES for short. So the UTES we look at are companies that, in addition to owning local wires, they also own power generation. And again, our focus is on those that play a larger growing role in energy transition, because the utilities include higher regulated local wires assets. They tend to be lower beta. We kind of just walk through that, lower risk relative to the IPPs. So to be clear, in our eyes, energy transition is an evolution. Our team looks at all energy infrastructure. We have a deep understanding of what the world needs. These companies within Renews, some of them will have fossil fuels, meaning they'll have some kind of legacy coal that's likely going to go out of business soon, or they're going to close those coal plants down, or natural gas. Because this is at the moment we've always thought that the transition to net zero, carbon free, was going to be an evolution that would require some fossil fuel, some traditional energy in order to kind of maintain the grid. We're not purists, we're realists. We believe in energy transition completely, but we also believe the world isn't ready to be short energy, and energy transition is exactly that, a transition. And again, from an income perspective, our approach is much more beneficial, as it will come with much less relative risk than what you may find elsewhere in energy transition. Okay, so here we are. We believe Renews is a better way for long-term income-oriented investors. Contracts that support renewable energy are either long-term in nature with the pure plays, or embedded in utility rate base that has a captive consumer market. So either way you look at it, those the contracts, the PPAs that come with on the IPP side tend to be several decades, typically 20 years, or they're embedded in a rate base for a captive audience, meaning it's built into the allowed return on equity that the utility is allowed to basically charge their customers. In other words, as long as these assets are producing electricity, they're going to get paid and they're going to earn their returns. And so they tend to be cash flow machines. These operators that we're focused on are cash flow machines. That cash flow can be directed towards incremental investments, because we're still so early in the energy transition. So there's a lot of opportunity out there. And they also support a stable and hopefully rising dividend. Okay, here it is. Oop. Seem to be that on the keyboards. Here we go. Okay, yield. Here it is. We use our Renew index as a proxy in our presentations. So our Renew index, you can see that on Bloomberg and on all the data providers. The name of it is the Eagle Global Renewables Infrastructure Index. If you're interested, Renew is not Renew's benchmark, but we set it up to mimic our universe. One of the chief requirements is that the constituent cash flow is sourced from renewable energy infrastructure has to be greater than 50%. I want to be clear about something though. So the Renew index has 25 constituents. Renew's universe is meaningfully larger. Renews does not have a restriction on the cash flow that comes from renewable energy infrastructure, because again, there are some companies that are really, really far along, but there are some companies that aren't as far along, but may have ambitious growth programs within renewable energy. We want to be able to invest in the whole universe that we see. So Renews has less restrictions than the Renew Index. So Renews is interested in both pure plays and others that are playing a role, right? So, but to put this slide into context, the Renew yield on October 31st, month end, 3.2%. Renews' yield is actually slightly higher at 3.4%. It's not on this slide, but to kind of give you an indication, that's where Renews' yield is at 3.4%. Either way, its yield is much higher than the S&P 500, the world market, MSCI, other renewable energy investments, and generic electric utilities. Not as good as REITs, and REITs are a quirky, wide-ranging, at times highly risky asset class, and of course not as good as a 10-year treasury, though at least right now it seems, you know, those rates are headed lower. I'll say that for Renews and for our dedicated SMA, the yield characteristics have been fairly consistent through the cycle. Not perfect, to be sure, but very consistently a solid yield. So let's dive a little deeper into the sector's characteristics. The foundation of the stable cash flows that support dividends is the Power Purchase Agreement, or PPA. Put simply, the PPA is long-term contract. Talked about this, typically 15 to 25 years. It specifies a fixed price for electricity. Customers benefit as the PPA provides long-term visibility on generation, reliability, and cost certainty. Meanwhile, developers benefit because it provides them a steady cash flow that allows them to secure and repay the capital that they raised to build the asset. And obviously, it allows them to price the proposed project for an appropriate rate of return. So also playing a role in this go or no-go decision, is obviously what you're getting from the PPA, but tax credits like the investment tax credit, or ITC, or the production tax credit, PTC, that comes with these renewable energy projects. And make no mistake, these tax credits, wherever you sit, they absolutely promote energy transition. It lowers the bar for developers to move forward on any given project, but they do need the visibility that these tax credits will remain intact, right? And that's critical. You need to know that those tax credits will be there. They're not going to be taken away or anything like that. Separately, the duration of a contract does actually fluctuate based on market demand. So I talked earlier about 15 to 25 years. You know, it wasn't that long ago, a few years ago, there was more competition in the market. There's no chatter about data centers and AI and electricity consumption going up through the roof. Contracts were coming with shorter terms. It was easier it was a buyer's market, if you will. However, enough players have now left energy transition as it became more difficult. Competition is lighter today. And of course, data centers have kind of changed, the paradigm has shifted. The market is starved for clean molecules, and so contracts are coming in with longer terms, which we view very positively, because the longer term, the more kind of confidence you have in that cash flow stream. You don't have to worry about kind of the end of the contract down the road. We think this is actually a very good sign of how healthy the market is, how in demand renewable is, and still, in the context of this presentation, once again, stronger contract means more confidence in the dividend. And as an aside, all of what I just said, it just played a meaningful role in why and how the sector has outperformed this year, where it's having a wonderful year, I think, hopefully you noticed. And we're often asked to prove, we kind of put this slide up on maybe earlier slides, we talked about how offering compelling risk-adjusted returns. And we're also asked, can you prove that data? Can you prove that comment, that kind of point? And I say, so we're data junkies, we're fundamental analysts. That's how we kind of run all our energy infrastructure strategies. So we ran the numbers, and then again, we use Renew Index as a proxy. The sector offers a better sharpened Sortino, a lower standard deviation, lower beta, and max drawdown versus the S&P Global Clean Energy Index. It's important to note that the S&P Global Clean Energy Index, actually includes some renewable energy infrastructure within it. So even though there's some within it, they also own a lot of those builders, but the fact that it has some infrastructure in it dulls the impact of this analysis. What I'm trying to say is that it would probably be more of it would screen even better if you kind of remove the energy infrastructure from the S&P Global Energy Infrastructure Index. You wouldn't do that, but if you did, it would screen better. It's one of the reasons we've also done the data against other subsectors within renewable energy using an ETF as a proxy. So like specific ETFs that focus on solar and wind, and it backs up that claim that I just made. So again, back to the builders, how the operators are going to be more stable than the builders, and performance has been pretty good over the long term. But coming back to the S&P Global Clean, just really wanted to highlight this one data point from this slide, which is max drawdown. If you're familiar with max drawdown, it's kind of how much has it gone down over any given period of time. We use a 3-year, I think it was a 3-year backdate, so it's not like 10 years or anything like that. But the S&P's global clean max drawdown over the rolling 3 years was nearly 60%, whereas Renew was just under 34%. You know, we all know that renewable energy has had a tough few years. You know, 23 and 24, 25 has been fantastic, as I said again, but you know, we understand that, but we like to believe that income investors are in it for the long term and want to feel confident in their investments. This huge difference in max drawdown is something that is a material differentiator. Anybody who's listening, feel free to reach out offline if you're interested in this data. We have it. And this is, again, like I said, for Renew versus other mainstream sectors. We're not hiding anything. If you want to compare it to the S&P 500, we can show that to you as well. Obviously, the comparison against the S&P 500, like a lot of sectors that aren't, you know, big tech, isn't as great, but we're happy to share it with you if you're interested. Getting back to the point, the long-term growth profile in our view is far more compelling in renewable energy infrastructure and energy transition. So come back to renews versus other typical renewable strategies on portfolio focus. We find that typically, not always, but typically most strategies invest upstream in the builders, high-risk manufacturers, emerging technologies, often in companies that lose money or have very short backlogs. And of course, little to no portfolio income, little to no dividend stream. Renewable energy infrastructure via Eagle Global, TrueShares Renews, we invest in mature companies. They own real assets that generate cash flow. They invest in proven businesses, establish revenue streams, have robust income supported by long-term contracts or PPAs, and a compelling long-term growth profile. Advantage, at least from our perspective, appears to be with Renews. All right, so what about the kind of big picture? Let's talk about this. So, you know, we talk about the benefits of owning Renews from a kind of income perspective, but what about the sector? Is there growth there? I assume you get the yield argument. So this is the other half of the total return. The way we look at the current market for renewables is a dual mandate. There's a dual mandate within energy markets. That is the energy demand rising seemingly exponentially, and the desire to generate more energy in a clean, renewable way. The race to dominate AI has and will continue to put enormous pressure on energy infrastructure. The market can't keep up. Just do a Google search and the AI will probably tell you that we're right. At the same time, hyperscalers, which are obviously the driving force behind AI, and importantly, the general public, they still desire energy transition, and that is, in essence, the dual mandate. That energy demand is accelerating rapidly, specifically electricity demand is accelerating rapidly, and the drivers of that growth want clean energy. That's the dual mandate that we're talking about. So this is a slide that comes from Wells Fargo. The blue line shows that through 2032, the data center electricity consumption will go from basically 0 to 1,200 terawatt hours. I had to look this up. That's nearly 1.2 petawatt hours. For those that don't know what is higher than a terawatt, it's unfortunately not a gigawatt. Probably dated myself there, but anyway, now 1.2 petawatt hours may not be meaningful without context. So the blue line shows, it depicts how much this consumption would be relative to 2024 total generation. So in other words, 2024 data centers accounted for very little of total electricity consumption. By 2032, and using 2024 as a base, it will account for 27%. This is just AI. Doesn't account for the electrification of everything else, which is points that we made elsewhere as well. Electric vehicles and industry. Probably not many people know that even in the oil patch, oil wells are increasingly turning to electricity to drive the rigs and the pressure pumping equipment. The electrification of everything is happening, even if it flies under the radar. It includes more than just the II race. It's just the II race dominates the headlines, and for a good reason, because it's pretty massive energy. Okay, so freeze up here again. Second.
I can change it for you if it froze up, Mike.
Yep. Okay. I think we just got to go up to slide 12. Perfect. Thank you, Mike. Blue line on the line graph takes what we just talked about and shows it another way. That is, electric demand has been flat for decades, and now it's rising. It's raising into the low to mid single digits. This is the forecast from Wells Fargo. Always subject to change, we know that, but the numbers have been moving higher. That's the point. And we could actually cherry pick some other experts that have a much higher range than what you're seeing here today. The four main hyperscalers, Amazon, Google, Meta, Microsoft, that's alphabetical order, each has net zero targets spelled out here. Not going to read them. Some are more ambitious, may have to be even pushed back a little bit. The point is they haven't, for the sake of winning the race, completely abandoned those goals. And that's key. That's kind of what we're talking about with the dual mandate. The bar chart on the side is also worth highlighting. Quarter over quarter, that is basically before and after second quarter earnings, forward year CapEx for the hyperscalers went up 22%. And that's 20%, 22% on an enormous number. That's $78 billion higher. It's just an enormous amount of money being thrown into the AI race. And the AI race depends enormously on procuring a ton more energy. This is good for all energy infrastructure, since we're going to need more energy from all sources. And this is something we've been saying for a long time, even before AI took off, that the world is generally short energy infrastructure. We simply don't have enough of it to deliver the energy that we need, and it's only gotten worse with the, with AI. Okay, this is the final slide to just emphasize the point I've been making about hyperscalers. Hyperscalers represent 4 of the 5 counterparties on contracts signed by corporates over the last few years. This is PPAs that I'm talking about. They're driving the boat. You may notice that the first half of 2025 has seen a remarkable decrease in PPAs signed. 2 points to make here. We think lack of clarity on policy largely played a pretty large role. And now that the one big beautiful bill has provided visibility, we think the PPAs that are being signed will jump higher. Also, if we did the math correctly, renewable energy represented roughly 30% of the PPAs signed in all of these periods. So what I'm saying is that even though the absolute number came down quite a bit, the proportion of renewable energy PPAs held firm. We thought that was fascinating. It wasn't as if they said, while we're waiting for clarity, we're going to just stop doing renewable energy. They actually maintained that percentage where it was. So the idea, what I'm trying to kind of imply, it's possible that as that number goes up again, you keep that 30% of PPAs static, and then you end up with a significant more, you're just going to need a lot more renewable energy. Again, we kind of look at this as a sign, another sign of the sector's resilience. And I'm finally just focusing on corporates and hyperscalers. Keep in mind that for anybody worried about the one big beautiful bill getting repealed or things changing at the federal level, the state governments very much drive demand as well. That hasn't stopped, especially in blue states. But here's a fun fact. Red state Texas is by far the largest developer of wind and solar in the country. That surprises people, I probably should, but renewable energies, you could make a case, has gone bipartisan. Okay, key risks. We wanted to walk through some of these just to be clear. Renews is thematic. It is an active ETF. One we classify as energy infrastructure, renewable energy, energy transition. The first risk is going to be hyperscalers mainstream, and Main Street could reverse their support for energy transition. The hyperscalers can make that decision that winning the race matters more than net zero. That's going to hurt. Also, Main Street, you probably have been reading about affordability crisis in the news. Energy inflation could push back on higher costs via the regulators' price concessions, working to kind of lower that cost to consumers. Anything like that, anything that could kind of push down the return or kind of the visibility for the companies that build this stuff, it's going to hurt. In a market of low supply, some companies will enter the market to try and solve problems and turn a profit. We're seeing lots of promises on energy development. There's always the potential for an overbuild of energy infrastructure, either through excess construction, increased supply, or an unexpected moderation in energy demand. I'm sure everybody probably remembers earlier this year, DeepSeek, where all of energy kind of got crushed on that. Since then, it doesn't seem to have stopped the hyperscalers from working on, from spending more money. So they must have not been too concerned with that AI energy efficiency. But the way we think it would play out, if that were to happen, energy efficiency were to slow down that demand for energy, that would hurt our sector just as well as a lot of other energy dependent sectors. again, in that type of environment, kind of going back to that risk slide that we showed earlier, we think the operators would outperform in a market relative to those on others on the same chain. Third, there are several emerging technologies to address nuclear SMRs. If there's any questions about that, I can kind of tell you why we don't think that is a near-term solution. Geothermal is another. There's lots of more. There's lots of other kind of emerging technologies. We think they're exactly that. The market needs power today, but to the extent that we're missing an emerging technology that kind of advances faster than we thought, that would be negative. And then the final, is just a lack of discipline by management teams. And I'm really emphasizing this one because this is kind of what we believe really hurt the market in 23 and 24, which was that we just had too much money chasing too few projects. Too much money out there. Let me start that again. Too much competition out there, which drove down return expectations. They really dropped the bar on that. They dropped the bar in risk mitigation, kind of got caught off guard with the inflation crisis. We think a lot of lessons have been learned. I'm going to tell you right now that I'm not saying that this time is different. It's not. We're always going to be on the lookout for this type of misbehavior and hold management teams to account. But at least in regards to the missteps from 23 and 24, we believe a lot of those have been corrected in contracts. There's inflation escalators in these contracts now, and there's just a hard line on if we're not getting the appropriate returns, we're just not going to move forward on a project. And that's helped right now because there is less competition in the market. All right, this is just a fun slide. I'm going to go through this really, really quickly because we're approaching that 30-minute mark. It's just to highlight that renewable energy tends to outperform during Republican administrations and underperforms during Democratic administrations. We did this analysis out of curiosity. We actually started on the traditional oil and gas side, and it actually holds true for that as well. That is, traditional oil and gas tends to outperform during Democratic administrations, underperforms during Republican administrations. My response as to why is not scientific. I think it has a lot to do with management discipline, that last bullet point we just talked about in the key risks. I think when management teams face an adversarial environment, they tend to be more conservative. They move forward on only the best projects, and to the extent that they have extra cash flow after that, they're just going to return it to shareholders, return of capital, which is wonderful. We really, really like to prioritize return of capital within our energy infrastructure strategies. And then another point, and this is something we wrote about in our last quarterly letter about that management discipline. Those companies that are forecasted to have less CapEx in 2026 or the next year versus this year have been outperforming those that have higher CapEx in 26 versus 25. That gets back to the idea that they're being more conservative. Investors are rewarding companies that have their ship in order, that are returning capital to investors. I want to be clear about something too. The razors category, there are companies in there that don't want to have to raise CapEx. They don't want to have these projections. They have to finish their projects that they put in, that they started. So some of them have plans to reduce CapEx in 27 and 28. They just have to get through. Once you start a project, these can be multiple years. They need to finish them so they can generate the cash flow and support the dividend and dividend growth. So my point being is that even the razors, that there's opportunities within the razors, just like there's opportunities, just like right now cutters are outperforming the razors, but down the road the reverse could be true as they get there. So we talked about yield. I'm sorry for this gimmick. I'm sorry, this is the next, this is EV to EBITDA slide. We think valuation is compelling. You look at, this is basically Renew, again, using our Renew index versus the other income-oriented sectors in the broader market. It just trades very, very cheaply. I don't think that the market appreciates the growth potential there. We actually think there's a very solid argument for it to trade at a premium to the electric utilities. It has done that in the past, but we'll just be happy with multiple expansion to a level that is even just consistent with where the electric utilities are. And then back to, this is where I was getting at. This is a gimmick. I did this slide earlier today. I just wanted to kind of reemphasize the point that the yield in the sector is very healthy. We do forecast growth for a majority of our companies within the sector. And so we're just very confident in this yield, and we think that it screens well against a lot of the other income-oriented sectors as well as the broader market. And then a couple more slides left. Thank you for dealing with me. Just to summarize the end of the presentation, participation in the energy transition megatrend, that is the dual mandate, the electrification of everything. There's so much going on within energy that it sets up really well for those interested, for those that are long-term and think that infrastructure is, in very short in the market today. A lower volatility than most clean energy strategies, backed by stable fee-based cash flows, and then obviously portfolio income, which is again the reason for this call. And this is our team. So thanks for bearing with me. Went 30 minutes, just a minute over. We do have time for questions if there are one. I'll turn it back to you, Mike. Yeah, you kind of the moderator here if you have any questions.
Thanks, Mike. And thanks for your passion for the asset class. That's one of the key things I like about your presentations. We don't have any questions from the audience, but I have a couple, if that's all right with you.
Go for it.
First point is, thank you for the Doc Brown reference. As a fellow Gen Xer, that resonated with me. I don't know about the rest of the audience. But first and foremost, I mean, you've had a fantastic year, right? 32+% year to date. And after having seen that slide regarding how renewables perform under different administrations, now I'm curious, is it because I never thought I would put these two things in the same sentence, but a Trump bump in the renewable space? Or is it sort of projects maturing that are starting to yield results? Or lastly, or is it the discipline of the managers, as you referenced? They're more judicious with their allocations and decisions in this type of climate with this administration.
I'll talk about kind of the setup into 2025 by itself. First, it's a good question. I think that, I do think that corporate teams were moving in the direction of return of capital and prioritizing free cash flow and only the best projects. And the election of Trump pushed them to do it even more. I mean, RWE, which is a German company that's a pretty sizable position in our portfolio, introduced a share buyback program. There's others that are doing it. I also think you kind of think back to 23 and 24. The sector in 23 got hit pretty hard, 24 got hit pretty hard, and then Trump started getting momentum, and you just entered into a kind of oversold kind of setup where, in my history, when I was at Goldman on the sell side for 10 years, and then in 11 years I've been at Eagle. Whenever you kind of experience a sector, they tend to get overbought, they tend to get oversold, they never just get slightly sold or slightly bought, right? So I think that the election of Trump pushed just the panic button on everything, especially with the rhetoric he had out there, and it just went into a massive oversold type of a setup. And so you kind of enter 2025 with that setup, and then you say, all right, as time started kind of continuing going forward, you started to say, oh, wait a second, the one big beautiful bill ended up being not as bad. We have visibility into 2030, which I'll point out could vary, but the way the political winds are blowing, who knows who's going to be in an administration. If we get a different administration, either administration could extend that further beyond 2030, but let's forget about that. You have the visibility to 2030. You have companies that are prioritizing only the best projects and returning excess capital to shareholders. There's just more confidence that this sector does have a future, right? And really, if you kind of rewind back to about a year, maybe a year and a half ago, there was a lot of people who thought renewable energy was just done. Energy transition is over. Trump's going to get elected. He's going to slam everything shut, and that's it. And in some ways, he has been bad for energy transition. I'm not going to deny that. I mean, the whole coal plants and stuff like that. I think the market was moving in the direction of closing coal plants, largely because of natural gas, the economics of natural gas, which is cleaner than coal and cheaper than coal. But then renewables, it's got a future. And I think when people started to realize that, they started saying, you know what, we can get back in. And so I think maybe a follow-up question would be, did I miss it? Could we go into 2026? You saw the valuation slide that I presented, that I showed earlier. The sector is super cheap. If you do believe in energy transition, I do believe Main Street, I do believe hyperscalers, I do believe everybody does believe in energy transition. These projects will get supported, they will get done, cash flows will grow, dividends will grow, EBITDA will grow, all that stuff will grow. And you should, at some point, the market will see that, and the multiples will expand as EBITDA grows up, which just sets up for a multi-year rally.
Okay, lines up for me. We have a question from the audience just came in. See if I can get this here. It says, assuming Ørsted is a fund holding, can you talk about the outlook for it? Hasn't the current administration canceled or tried to cancel a number of U.S. offshore wind projects?
Great question. And I love this question because it allows us to talk a little bit how the fact that Renews is an active ETF. We entered the year not owning Ørsted, so we had a 0% position. It's actually in the Renew index. It's in our universe. You know, but we did not have a position in 2025 for the early part of the year for exactly that reason. The one area within renewables that Trump was really attacking was offshore wind. Probably not the only area, but it was the most vocal in my eyes. Offshore wind, really pressuring Ørsted or everybody in offshore wind to, like, you know, just kind of get the heck out of here. And so our assumption was, so Ocean Wind got canceled in 2024. That was the project off of New Jersey. Revolution is most of the way done, and then it had been put on hold a few times, I believe. And then that's the one off Rhode Island. And then there's Sunrise, which is off New York. And that's the one that was a little bit earlier going. Ørsted had worked in 2024 towards renegotiating those contracts to make it profitable because that got caught on the wrong end of the inflation, cost inflation. And they were able to successfully kind of recontract those assets to make them to allow themselves to earn a return. We didn't own a lot of this stuff was known. We still didn't own it because we were worried that Sunrise was going to get pushed into getting canceled, and that was going to be the last step that we were going to kind of we were waiting for. However, in the interim, what happened just a few months ago was Ørsted came out with a large rights offering that really put its balance sheet into a much better place. The stock took a big hit, and we said to ourselves, active ETF, this is the time. Even if Sunrise gets canceled at this point, we think it's just too cheap to ignore. So if Sunrise gets canceled and we lose out a little bit in the short term, we think the long-term, medium and long-term setup is wonderful. We bought into it, and it's actually generated a pretty significant amount of alpha in our portfolio. I will say, though, that, you know, owning stocks is easy. Knowing when to sell them is actually the hard part of portfolio management. So we do own Ørsted right now for those reasons.
Great, thanks, Mike. And selfishly, I'm going to ask you one more question. And long and short of it, right? So we have a massive spike in judging by the chart you showed earlier, that trend will continue, but a massive spike in energy demand. We have a massive deficit in renewable energy infrastructure. And so where does the needle move from there? I mean, is the answer to this a combination of more efficient energy use and an uptick in infrastructure? I mean, if it were just infrastructure alone, renewable energy infrastructure trying to catch up to the needs of the grid, how long does that take? And is it sort of one of those things that the candle has to burn for both sides to get to the point where we can match up production with use?
Yeah, so in the near term, right, the massive spike in energy demand in our eyes is going to be met, you know, intermittently with renewables. That continues. There's a supply chain to massively ramp up renewable energy infrastructure, and that's kind of legacy from, you know, 2020 and forward, when renewable energy, there was a few years renewable energy did really well. So there's a supply chain for renewable energy to grow. But like I just said, it's intermittent. So what steps in to fill that gap? It's going to be natural gas. Medium term, long term, we can talk about kind of the path towards net zero, which is not dead in my eyes, is a combination of renewables and storage. And storage, by that I mean batteries, or there's actually a lot more out there than just batteries. I'm not going to get into all the stuff that they do on the energy storage side. We're kind of coupling energy storage together with renewable energy to get to a point where there's less intermittency, and you can start reducing the market share of natural gas as a percentage of total generation. So, or total energy consumption is what I should say. So I think, you know, I live in New York, so I have a lot of friends who ask me about the viability of exactly what you're asking, and I say, well, battery technology battery companies have done a great job. They've been able to cut their costs by about 90% since they started. They probably have to cut it another 90%. Again, that may not be lithium, right? The one thing when we're talking about is utility scale. Lithium, one of the benefits of lithium is that it's lightweight. It's perfect for phones. It's perfect for cars because you want to minimize the amount of weight. When I talk about energy storage from a utility scale perspective, you don't have to worry about weight. So there's iron oxide battery solutions out there that are being developed. There's lots of other different types of batteries out there that are being developed that could help reduce that cost another 90%. I'm not saying I didn't mean that to sound like it's impossible. I mean that to sound that that's the goal. But when you can combine those two together, you'll start seeing real solutions and a real takeover. That's probably more longer term, unless the technology is more advanced than I think. However, from, again, energy transition, we believe in that. One of the reasons a lot of people don't realize that in the US, we've cut our emissions dramatically over the last 25 years. I think the number's like 20%. Our emissions have gone down pretty significantly over 20 years, 25 years. It's because of the shale revolution and natural gas, because we've closed so many coal power plants. So you think about the rest of the world and their ability to kind of convert even from coal to natural gas. That would help reduce emissions. And then at the same time, they also kind of lump in renewable energy from a global perspective. And you're just talking about a massive amount of investment. But to actually get to that kind of that perfect world of net zero, it's going to take multiple decades. We look at that as an opportunity, though. This is not a megatrend that's going to end in a year or two. It's going to be multiple decades. And that just sets up so well for what we're trying to do here within renewable energy infrastructure.
Last question, again, from the audience, perfect segue, and we'll try to keep it short. I know we're almost 40 minutes in here, but how global is the universe and holdings of the fund?
Yeah, so good question. So Renews, we have the ability to invest internationally. And so right now, just over 50% of the portfolio is in Europe, is in the EU. So think companies in like Germany and the UK, Spain, Italy, Austria, stuff like that. About just over 30, so it's like 36% is in the US. So companies like Clearway, Nextera, PCG, companies like that. Now, Hannon Armstrong is another one, another holding, AEP. So 36%, and then we have about a 5% weight in Japan and New Zealand collectively. So that's like Asia and Oceania. And then another 5% in Canada. And I think one of the things to keep note of is that Renews has much more flexibility than our SMA, which it's common shares and ADRs within the SMA. Renews we can invest in the ordinaries, which is a huge advantage because the EU is still the leader in renewables, and it actually helps us to kind of better diversify the portfolio to get to a more stable kind of portfolio. Love our SMA, but we think Renews is actually a little bit more broad of universe, which does help. But that's the positioning in the portfolio. And I ended up making a short question long, Mike. I'm sorry.
No, it's all right. Very informative. Thanks, Mike. Listen, we're going to cut it off here. We know people have things to do, but a wealth of information. Mike Cerasoli, easily, if not the, but one of the most passionate and knowledgeable PMs in the space, is the portfolio manager of the TrueShares Eagle Global Renewable Energy Income Fund, symbol RNWZ. If you have additional questions, feel free to reach out to our team. Get us to the website at any point in time, which is true-shares.com. And as appropriate, we can also connect folks with a one-on-one with Mike to further drill down on any of the topics he covered today. So, Mike, thanks for the time. Always a pleasure, and look forward to hearing from you again.
Thank you, Mike, and thank you, TrueShares.